Picture this. You buy a property, it looks like a cash flow deal. The numbers made sense on paper. 12 months later, you're writing a check every single month just to keep the asset alive. 18 months after that, you can't sell without locking in a six-figure loss. That's not a hypothetical. That is happening right now to real investors in real cities on both sides of the Atlantic. And here's the part that should genuinely unsettle you. The cities causing the most financial damage in 2026 are not the obvious ones. They're the ones still being recommended, still being marketed, still showing up in the YouTube thumbnails and the newsletter headlines as top investment markets. I'm going to name them. I'm going to show you exactly why the math is broken, and I'm going to give you the framework that separates investors who build real wealth from investors who just own expensive, complicated problems. Here's what's coming. There's an American city where investors are reporting 12% yields and quietly losing money in real terms every single month. There's a European capital so aggressively regulated that your net yield now sits below a risk-free government bond. And there's one market, considered safe by almost everyone, where institutional money has been quietly exiting for over a year, while retail investors are still buying in. We'll cover all of it, the hidden costs that destroy paper returns, the regulatory traps swallowing European portfolios, the appreciation myth that is still catching people off guard, and the single mental shift that changes how you evaluate every deal from this point forward. Let's get into it. Section 1. The cheap city trap. Let's start with the mistake that costs investors the most money the most quietly. Confusing cheap with undervalued. These are not the same thing, not even close. An undervalued asset is priced below what the market will eventually recognize its worth. The demand is real, it just hasn't been fully priced in yet. A cheap asset is just unwanted, and unwanted assets are unwanted for a reason. Take Memphis, Tennessee. Imagine opening a listing, sub $100,000 entry price, reported gross yield of 12%, sometimes 14% in certain neighborhoods. From a desk in London or Toronto or Frankfurt, that looks like an arbitrage. It looks like the market hasn't noticed something you have. But here's where investors lose six figures without realizing anything went wrong. Vacancy rates in parts of Memphis consistently run above 15%, 1 in 6 units sitting empty. Property management in economically distressed neighborhoods costs more than in stable ones. Higher tenant turnover, more frequent maintenance calls, eviction timelines that can drag for months under Tennessee law. Now run the honest math. Subtract management fees, insurance, property tax, maintenance reserves in realistic vacancy. That 12% gross yield, you're looking at 3 to 4% net in a good year. In a bad year, you're below zero. And appreciation doesn't save you. Memphis has delivered minimal real price growth over the last decade adjusted for inflation, so you're not building equity at any meaningful rate. You're not generating real cash flow. You're managing a problem at a distance for thin margins in a market with no compelling upside catalyst. Detroit follows the same script. Pockets of genuine revitalization, Midtown, Corktown, the Woodward Corridor, are real, but large sections of the city remain structurally distressed. The population has declined by approximately 25% since 2000. You cannot build a durable property investment thesis on a city consistently losing the residents that generate rental demand. Ask the question every time, why is this cheap? If you can't answer it with precision and confidence, stop. You're not looking at an opportunity. You're looking at a trap wearing one. Section 2. Markets that used to work. Now here's where it gets more dangerous, because so far we've been talking about obviously distressed markets. Most serious investors already know to be cautious there. The real damage happens somewhere else entirely. It happens in markets that made money recently and now are coasting on the reputation of a thesis that no longer holds. Austin, Texas. You wake up, it's 2026, you bought in Austin in late 2022, tech-driven population growth, supply constraints, compounding appreciation. Every analyst, every podcast, every real estate influencer said the same thing. Austin is a must-own market. The narrative felt airtight. Here's what happened next. Austin saw one of the largest multifamily construction booms in the entire country over the following 2 years. Supply didn't just catch up to demand. In some segments, it overtook it. Vacancy climbed, rent growth stalled, and landlords who bought at 2022 prices are now competing in a tenant-favorable market, offering free months, waived deposits, concessions that erode an already thin margin. Entry prices never corrected meaningfully from the run-up, financing costs never returned to emergency lows. The result, negative cash flow on an expensive asset in a market with a growing supply overhang. This is how the trap closes. You're not in a bad city. You're in a good city at the wrong price, at the wrong time, with the wrong supply dynamics. Every month, you're subsidizing the asset. The only exit is appreciation, and that requires demand to absorb a substantial pipeline. That's not a strategy. That's a leveraged prediction. Phoenix runs the same playbook, with one added variable most investors didn't model: insurance. Wildfire risk, extreme heat exposure, and increasing climate-related underwriting pressure have pushed insurance premiums in parts of Arizona sharply higher. Some investors have seen premiums double in 3 years. That's a permanent structural cost increase. It doesn't mean revert. Smart capital saw this shift coming over a year ago. The question is, are you the investor moving before the crowd catches up, or are you the person buying what smart money is quietly offloading? Here's a direct question. Are you building a portfolio that actually performs, or one that just looks good on paper? If you're serious about the difference, subscribe now. Every week we publish the kind of market analysis that lets you move before the crowd catches up. No fluff, no hype, just fundamentals. Hit subscribe and let's keep going, because the next section is where most investors are getting quietly destroyed right now.
Section 3. Europe, where regulation is your silent business partner. Let's go to Europe, because this is where international investors, particularly from North America, walk into something they genuinely didn't see coming. Not market risk, not vacancy risk, regulatory risk. And in 2026, it is actively dismantling returns in several of the most prestigious addresses on the continent. Berlin. Let's go there first. Imagine you own a property in Prenzlauer Berg, a neighborhood with real demand, a growing population of young professionals, genuine rental appetite. You should be collecting market-rate rent. You should be building a return. But Germany's Mietpreisbremse, the rent brake, legally caps what you can charge relative to the local reference index, the Mietspiegel, which is itself structured to suppress market-rate pricing. In practice, you own the asset, you carry the costs, you bear the risk, but the government determines your revenue ceiling. Your upside is capped by policy, your downside is not. Now factor in the acquisition cost structure. Real estate transfer tax in Germany runs up to 6.5% depending on the state, notary fees, agent commissions on both sides. Total transaction costs on a Berlin investment property can hit 10 to 12% of purchase price before you've collected a single euro of rent. You need significant appreciation just to break even on exit. Here's the number that should stop you cold. In some cases, after full costs are honestly accounted for, net yields on Berlin residential investment property sit below 2%. German government bonds, Bundesanleihen, are currently yielding more than that. Zero tenant risk, zero regulatory risk, zero maintenance calls at midnight, and a better return. When a sovereign bond outperforms your property net of costs, you don't have an investment, you have a liability with a postcode. Barcelona. Spain has been rolling out national rent control legislation, with Barcelona as the testing ground. When Catalonia introduced hard rent caps between 2020 and 2022, rental listings in affected areas dropped by 30 to 50% within months. Landlords exited, supply collapsed, affordability worsened. That's the regulatory paradox. Intervention designed to protect renters consistently destroys supply and ultimately harms them. But while that political cycle runs its course, your capital is trapped inside it. Paris is expensive to acquire.
expensive to hold, and navigating vacancy can be a lengthy legal process. Paris works for non-leveraged wealth storage at the ultra-high net worth level. For investors with a yield mandate and financing costs to service, the math almost never closes. Section 4. The appreciation trap. This is the most dangerous section of this video because this one challenges something that feels like common sense. High appreciation does not protect you from a bad investment. Let me say that again, more directly. Buying on the expectation of future appreciation, especially with leverage, is the single most psychologically seductive and structurally hazardous strategy in real estate, and right now, it is still being sold as wisdom. Here's why it fails. Appreciation is retrospective. You can only confirm it after it's already happened. When you buy anticipating future price growth, you are making a prediction about employment trends, demographic shifts, policy decisions, interest rate trajectories, and supply pipelines simultaneously over multiple years. That's speculation. And speculation with an 80% loan-to-value mortgage means you're paying the cost of being wrong every single month. San Francisco. Picture this. It's 2019. San Francisco residential property is trading at valuations that imply permanent, compounding demand from the technology sector. The city is supply-constrained, globally prestigious, feeding the highest income industry on Earth. Investors and homebuyers aren't buying yield, they're buying certainty. They're buying the story. Then, remote work restructures the geography of knowledge work overnight. Urban density becomes optional. Population contracts for the first time in decades, office vacancy hits record highs, and properties purchased with negative carry, serviced monthly by capital, not cash flow, become anchors. Now there are two investors. Investor A bought with positive cash flow, conservative vacancy assumptions, and a long-term hold thesis. They felt pain in the cycle, but the property paid its own costs. They survived, held, and are now in a recovering position. Investor B bought the story. Negative carry, appreciation thesis, no cash flow buffer. When the market shifted, they faced a binary choice: sell at a loss and crystallize the damage, or keep writing checks on a deteriorating narrative. One of these investors built wealth. The other learned an expensive lesson about the difference between a story and a business. Cash flow is the defense. Appreciation is the bonus. The moment you invert that relationship, you're not an investor anymore. You're a speculator with a mortgage. Prime Central London presents the same risk in a different currency. Stamp duty reform has changed the acquisition economics significantly. The 3% additional surcharge on investment properties, combined with upper stamp duty bans, means buying a £2 million London investment property can trigger acquisition taxes exceeding 15% of purchase price. Net yields on prime London residential often land below 2% before financing costs. That works for long-term, non-leveraged wealth storage. It does not work for cash flow investors. And yet, people are still buying it as though it does. Truth bomb. I want to say something that the real estate industry does not want you to hear. The always be buying property mentality is not a strategy, it's a sales pitch, and it is costing investors serious, real compounding money. Real estate is an asset class, like every other asset class. It has cycles, it has geography, it has pricing that can be deeply wrong for years. The cities in this video are not bad places. Many of them are culturally significant, economically important, globally recognized. But here's the critical line most people never draw. Desirability and investability are completely different calculations. What makes a city genuinely investable in 2026 is a very specific combination. Population growth driven by employment, not just demographic migration. A regulatory environment that respects property rights and permits market-rate rental income. A supply pipeline that is genuinely constrained relative to structural demand. Entry pricing that delivers honest net yield after every single cost is modeled conservatively, and financing conditions where operational income can actually service the debt.
Right now, very few major gateway cities satisfy all those conditions simultaneously. Here's the identity shift that separates real investors from everyone else. They don't buy city reputations, they buy fundamentals. They don't fall in love with narratives, they stress test them. They don't chase what's famous, they chase what's underpriced, underleveraged, and misunderstood by the crowd. Smart capital is already out of several of these markets in this video, quietly, systematically, without announcing it. The only question is which side of that trade you're on. Let's make this concrete. Memphis and Detroit, entry price traps, gross yields that never survive honest cost modeling. The cheapness is the warning, not the opportunity. Austin and Phoenix, markets that worked in a different rate and supply environment, now facing inventory pressure, rising insurance costs, and compressed cash flow on pricing that hasn't corrected. Berlin, Barcelona, Dublin, Paris, regulatory environments where policy risk is a permanent structural feature and where net yields in some cases now trail risk-free alternatives. That's not an investment. That's a trade with all the downside and a government-capped upside. Prime central London presents the same risk in a different currency. Stamp duty reform has changed the acquisition economics significantly. The 3% additional surcharge on investment properties, combined with upper stamp duty bans, means buying a £2 million London investment property can trigger acquisition taxes exceeding 15% of purchase price. Net yields on prime London residential often land below 2% before financing costs. That works for long-term, non-leveraged wealth storage. It does not work for cash flow investors. And yet, people are still buying it as though it does. The pattern never changes. Investors fall in love with narratives, with city reputations, with past performance, with the comfort of buying what everyone else is buying. And they skip the one thing that actually determines outcomes: the math. Don't make emotional decisions with leveraged capital. Think long-term, model conservatively, know your exit before you enter, and treat every property the same way you treat any other business. Does the income justify the cost, the risk, and the capital commitment at this price today? The investors who look back on 2026 as a turning point won't be the ones who bought the most famous markets. They'll be the ones who had the discipline to walk away from a bad deal, even if it looked good on the surface. That's the edge. And now you have it. If you're building a portfolio that actually performs, not just one that looks good on paper, subscribe now. This is what we do every week.